Hi, welcome to the show. I'm your host, Adam Mueller with the State Your Business podcast. Today we're going to be talking about how you as a business owner or real estate investor can defer your large capital gains tax bill when it's time to sell and keep the money invested for the benefit of you and your family. The vehicle we're going to be talking about today is called a Deferred Sales Trust, or a DST. And to help us learn about this today, I have with me Kent LeFevre, who is a National Deferred Sales Trust trustee and lives here in the Minneapolis area, and who I've had the personal opportunity of selling my business with my wife for us to preserve our wealth and defer our capital gains tax. So Kent, do you mind sharing how you got to this place today?
Sure. So I guess career-wise, family-wise, I live here in the Minneapolis area. I have 7 kids, 7 grandkids, and been married to my wife now 37 years. And so
congratulations.
Thank you. Got another anniversary coming up here soon. Professionally though, I started out my career at Ford Motor Company as a financial analyst, became director of finance for a healthcare company here in town. And then about 27 years ago, that company got sold, and so I got full-time into a real estate investment company. So for the last almost 3 decades, I've owned a real estate investment company, and did a lot of different things with real estate, value-added, flips, rentals, new construction, but primarily rehabs and rental portfolio. And so about 8 years ago, I and my business partners were looking at a way to defer taxes when we sold off about half of this portfolio. And in our situation, we really didn't want to do a 1031 exchange and get back into real estate again. We wanted to take some money off the table, but we really wanted to defer the taxes. Here in Minnesota, when you sell, tax rates are about 35% between federal, state, and Medicare. So it's a huge amount of money that you lose. And so we did a lot of research, and we came across this structure we're going to be talking about today, the Deferred Sales Trust. I did a lot of research on it, vetted it with my CPA, my tax attorney, and got the green light to start using it again about 8 years ago. And so to date, I've sold 32 buildings using the structure myself, rolled all of that tax money into a deferred sales trust. And what it's allowed me to do and my family to do is to preserve all of our wealth. We didn't pay any taxes at the time of the sale. And I think about this a lot like I call it my private 401k. And so it's not a 401k plan, but essentially from a tax perspective, it's enabled me to put tax deferred proceeds into a trust, the deferred structure, to grow that money tax deferred, kind of like what you would do with a 401k. And then I'm only taxed on the money that I take out for income. And so it's been a great blessing for me and my family. We were able to preserve that wealth and then keep that money working for us on an ongoing basis. So it's working very well. I've got closing on a property today, actually. I've got 19 more properties to sell to be completely sold out of our real estate portfolio. So I've been really grateful to have this vehicle as an instrument. About a year and a half into working as a client with the Deferred Sales Trust, I saw the value that this created for me and for other people I was seeing using it. So I went back to a company called the Estate Planning Team, who helped create this structure about 27 years ago. And because of my financial background and being a real estate broker and a fiduciary for a long time, was able to become a Deferred Sales Trust trustee, working nationally with sellers. And so for the last 7 years, I've been helping teach other people about how this works, help them evaluate if it's a good fit for their situation, and then most importantly, see if it's a good fit for them financially on reaching their future financial goals. And if the answers are yes to all those questions, then our tax law firm helps implement this for them before they have their sale. We get it implemented. So it's been just a lot of fun to work with sellers from all over the country who are deferring millions of dollars in taxes and preserving their wealth. And so I get a lot of enjoyment out of teaching people how it works, and if it's a good fit, then really just love working with them and helping them reach their financial goals using this as a tool.
What's a good example of something that's a good fit for this program, for the Deferred Sales Trust?
Yeah, great question. So for the most part, almost any highly appreciated asset where there's a large capital gain is a good candidate. So we're talking businesses, professional practices, real estate, cryptocurrency, classic cars, airplanes, whatever's highly appreciated where there's a large capital gains tax, there can be a benefit. There's very few situations where it's not a good fit. One of those might be, for example, if the seller is going to need the money very quickly, within about 3 years, they're going to need all of the money, then there's really no benefit from the deferral where we can invest that tax money and grow it over time. But if the seller has a long-term perspective, I need X amount for income, I want to grow the rest, and that's kind of their goal, then it's usually an excellent fit for most transactions.
What got you to the point of setting something like this up? Was it just the personal need? Is that what created it?
Yeah, so I never knew anything about this structure 8 years ago, and which is kind of hard to believe since I've been a real estate broker for 20 plus years and thought I knew all of the tricks of the trade, or let's say the tax deferral structures that were out there. I'd never seen or heard of this. It almost seemed too good to be true, right? But the more research I did, the more experts I talked to, the more I vetted it, the more value and the more credibility I found that this structure actually has. It's been audited by the IRS 3 different times, 2006, 2008, 2019. All of them were no change audits. It's been audited by California 7 times, all of them no change audits. So it's withstood scrutiny by various taxing authorities and found to be compliant. So that gave me a lot of confidence to move forward with it. But it was really my personal need that drove our looking for something like this, and we were just fortunate enough to find it before we started selling, because I'd be in a very different financial position right now if I'd sold without this structure in place. We're talking millions of dollars in taxes that I would never see again. And so it doesn't eliminate the tax, but it defers and allows us to invest that tax money, which is a great thing to have, is you can have that extra money working for you for an extended period of time.
How would you define a deferred sales trust? If somebody's new, they want to know, hey, what's a DST? What's a deferred sales trust?
What is it? Sure, great question. So the easiest way to describe it is it's a structured installment sale. If you're in real estate, I often call it seller financing. What we're essentially doing is we're taking a transaction between a seller and a buyer, where if that transaction happened on its own and there was nothing done to defer taxes, as soon as the money came from the buyer to the seller, then they're going to pay the tax bill. So what we're essentially doing is we're taking a transaction between the two parties and we're inserting an independent third-party trust. In this case, it's a business trust. And so we're doing an installment sale between the seller and the trust, which essentially means we're not only selling the property or the asset to the trust, but we're also being the bank. We're saying, okay, I'm going to finance this purchase to the trust. I'm going to take back a secure promissory note, which means a promise to pay. So I'm going to get my full amount of my net proceeds over time in the form of payments, right? So that's going to be, the IRS says, this is called IRC, or Internal Revenue Code 453. You don't need to memorize that at all, but essentially what the law allows is when you sell an asset and you sell or finance it, you're deferring the taxes on the sale and you're paying taxes only on the payments as you receive them. So that defers taxes on usually most or all the taxes that would be due. And then you're going to incur just the taxes on the payments as they come back in. So we're setting up a structured installment sale. We do need to do this before the closing occurs. And then the trust, once it acquires this asset via installment sale, it can sell it for cash to the buyer. And that's what funds the trust, is the money comes into the trust because the seller has sold their interest in the asset to the trust just before closing. In exchange for this note, they're deferring their tax bill. But we don't have the risk that normally comes with seller financing, is where if the buyer bought it and you seller finance to the buyer, who knows what they're going to do with the asset, right? They either know what they're doing or they don't, right? So this removes that risk, and so the buyer pays cash for the property, or maybe they pay mostly cash, and then there's some installment payments that come into the trust. But the point is the trust receives the funds, and so from there, the seller can approve how they want the money invested. Okay, so they get decision power over how that money is going to get invested. So to go back to my early example, it's a lot like a 401k, where you get to select or approve the investments you're going to invest in. You're deferring the taxes. The growth that you make on your investments is all tax deferred, and then you're just taxed on the payments as you receive them. So it's a kind of, in a nutshell, structured installment sale designed to defer the taxes, where you can receive income and only be taxed on that income.
Have you ever had anyone besides me that has asked you, hey, what's it look like 20 years from now if I sell my business and I don't use a DST or a deferred sales trust versus using it?
Oh yeah, yeah. In fact, it was a question I had. What does this look like for me? 10, 20 years out and side by side. From a baseline comparison, if you think about if you sell and you pay the tax, all that money goes away. You'll never see it again. You'll never see any benefits. But now, then also what you're going to be reinvesting is going to be some kind of a taxable investment, right? If you put it into an investment account, you're going to be paying taxes on everything that money produces every year, whether you needed all that income or not, right? If you're in a deferred sales trust or this 401k-like structure, you've got your tax money that you didn't have to write a check for. You've also got your net proceeds, which you would have over, on the taxable side. But now that net proceeds is also tax deferred. So you're getting tax deferred compound growth on all of that money in its entirety. So what we do to help people kind of visualize this is we can do a free DST illustration. So with the specifics of the sale that the seller is thinking about doing or is planning to do, we can show them a side-by-side comparison. If you sold it, paid the taxes, what would that look like if you invested it over 20 years versus using a deferred sales trust? And inevitably, the bigger the tax bill, the bigger the difference is between those two. And that's just something we do for free for sellers. With a little bit of information, they can request this free report, and we can produce it for them, and then help them analyze it and see if it's a good fit for them.
What do you feel qualifies you as a trustee?
Yeah, good question. So my background is in finance. I've run a lot of different companies myself, including real estate companies, and that's a big part of selling a business is understanding how businesses work. I've been involved in corporate taxes for quite some time, and that's another part of what we're deferring is the taxes. And then I've been a fiduciary as a real estate broker for 20 plus years, and also trustee of a number of different trusts during that time for different clients. I've had the background and experience to be able to, actually, it's almost like I was, I wouldn't call it maybe destined, but prepared to be able to fulfill this role just because of my life experiences and the background that I've had. It's just been a really good fit, both financially as well as kind of knowledge base to be able to help people, go through the same thing that I've been through. I think probably what qualifies me even more is that I'm actually a client, so I can sit on the seller's side of the table and help them understand this from their perspective, and then also I know how it's administered, so I can kind of give them the benefit of both sides and help them evaluate objectively if it's a good fit or not for them.
What would a DST cost somebody?
Yeah, good question. So there is an upfront cost for the attorney, the law firm, that's going to put the structure in place. And that's based on the gross sale price of the asset. And so his fee is 1.5% on the first $1 million of gross sale price, 1.25% on each million above that. And then for larger transactions, 10 million and over, there's usually some additional price breaks that are put in there. So that's the one-time cost for the transaction. As far as annual cost, there's a trustee fee and a wealth management fee. And so the trust has its own wealth manager firm that will manage the money in the way that the seller approves. And then there's a trustee fee for managing the structure, keeping it intact. And that's kind of my role as a trustee. I manage the structure itself, but I don't touch the seller's money. That's what the wealth manager does. They manage the money in the way that, invest the money the way the seller wants it done. So that fee depends on how much assets we have in the trust. So the trustee fee starts about 0.85% per year and goes down to about 0.45, depending on the size of the assets we're managing. And then the financial advisor fee can be anywhere from 0 to above 1%, just depending on what assets are selected, what the fees are for those assets. So it's best to have a conversation specifically about the sale, but those are kind of the ranges. Most annual fees are going to run somewhere between less than 1% up to about just above 1% on an annual basis. Now the trust gross return pays for those fees, so they're not writing a check for that. So for example, if the trust assets were earning 9% gross and the fees were 1.5%, you'd have a 7.5% rate of return on your money, to give an example.
And you mentioned that a DST, a deferred sales trust, is a lot like a 401k. Now, my father-in-law in his retirement has decided, hey, I want to do a bathroom remodel and I want to borrow from my 401k or whatever it is. Maybe somebody wants to borrow from it. Are there any benefits or advantages with the deferred sales trust to use those deferred tax dollars to invest in other things?
Sure, yeah. So there's kind of two ways to do investments, and also if you're going to do something personal as well. So with a deferred sales trust, we have a lot of serial entrepreneurs who sell a business and then want to, a short time later, buy another business or start another business. So the trust is very flexible in the investments you can make. We have the traditional stocks, bonds, mutual funds, and alternative investments, and a whole host of other things you can invest in within the trust. But if business creation and growth is your thing, then we have the ability also to have the trust partner with the seller in a new business, and we can use tax deferred funds to do that. We put it into an LLC, and then the seller can run the LLC the way they normally would, but we're using tax deferred dollars to do it. It's just not something you can do in a 1031. From a real estate perspective, though, you could also buy real estate, again, using that same structure, joint venture, LLC. Trust is your silent partner, your money partner. And then the seller can then use the LLC to acquire another building. So it's an alternative to a 1031. And the example you gave of someone wanting to remodel a bathroom, let's just say that they needed $15,000 and it wasn't part of their monthly income that they're already receiving. We could amend the note, and as a trustee, I could prepay the note by $15,000 and then just give them a lump sum. We would just modify the note, amend the note, and then put $15,000 into their checking account. If they're going to do something personal, it's a taxable distribution. But it'd be similar to taking money out of a 401k, except in some cases it's tough to do that. There's penalties and so forth with 401k, and this doesn't have any of those types of penalties. It's pretty flexible.
Speaking of needing money, let's say somebody gets into a situation where they sold their company for $1 million plus, and they need $50,000 or $100,000. Would they have the option of having that lump sum taken out and having the note amended?
Yeah, absolutely. Yeah, so the note's pretty flexible. We just need to know kind of what the need is that's arisen. Life happens. Things don't always go as planned or as scheduled, right? So if we have that need, then we just amend the note, and then we just prepay the portion of the note to generate that cash that they need. So there's a lot of flexibility. I, as a seller, as a client, never had to worry about if I can get money if I need it or when I need it, because it's a pretty flexible structure in terms of being able to amend the note, get unscheduled payments at whenever that might be needed. I've had clients who found their dream home and needed $2 million unexpectedly out of this very large trust, and so we work with people to help them accomplish what they want to do in a very flexible way.
What's the best timing for a deferred sales trust?
Yeah, great question. So the timing's critical. So normally for a business sale, it's best for us to, first of all, it's best to get some education on this first. So we do that via a free, no obligation Zoom meeting where we go through kind of the individual characteristics of what they're looking to sell and kind of the circumstances, just to help them assess if it's a good fit. We do some education more in depth on how the structure works to see if it's a good fit, and then determine if this is a good tool for them to use when the time comes for their sale. From a business sale perspective, usually we want to bring in our tax law firm at the point no later than when we're in a draft contract. So usually you'll get an LOI and kind of evaluate that and start some due diligence. When you get to the point of getting a draft contract, that's where we want to bring in the tax attorney. He may or may not need to add a little bit of language to the contract to involve the trust in the deal. Sometimes we can do it without modifying the contract. Sometimes we need to. So it's best to do that while everybody else is redlining the contract, to just have his language put in there. It's nothing that's going to concern the buyer. It doesn't interrupt anything or cause any concern. All of the representations and warranties that seller might be making all stay intact. But it's critical that be done before we get to closing, because we have to do this installment sale first and then have the closing. If that doesn't happen first, then there's no tax deferral and you pay the tax bill. So timing's critical. It has to be set up before you or down to closing. Draft contract stage is best. For a real estate sale, whenever we get a signed contract, that's the best time to get the tax attorney in play involved. And that's, again, just a Zoom meeting with him. Our tax attorney's very, very knowledgeable, been doing this work for 32 years. He's done over $30 billion in transactions, and he stopped counting about 10 years ago. But so he's a real estate attorney, a mergers and acquisitions business attorney, and a tax attorney. He also runs a 1031 exchange company and has a title company. So he's very vertically and horizontally integrated. So he's a real expert at any kind of transaction. He's seen it, he's done it. So he's a great asset to be able to work with.
Is the deferred sales trust willable?
So yes, and what we mean by that is the trust itself is a business trust. So it's an independent entity. The seller won't own the trust. What they'll get is when they sell, they'll get a secure promissory note. So they're going to have a promissory note. Think about it as you're selling your equity in a company and taking back a note for it. Okay, and then that comes with a security agreement that serves like a mortgage. So it secures all of the assets that are going to be in the trust to that note. So the money can't go anywhere. You're a secure party. Okay. So what you have is, if you've done one transaction, you have one note. If you do multiple transactions, you'll have multiple notes, all done with the same trust. Okay. So those notes are what's inheritable. So you can put that right into your existing estate plan, whether it's in a will or a family trust, or if you don't have anything, you can just kind of decide, or whenever you get around to doing an estate plan, you can decide who's going to inherit those notes. And so the notes are inheritable, so you can create some legacy wealth with this as well. You use the tax deferred wealth how you choose to during your lifetime. Decide, in your own estate plan, who's going to get the notes, and then whenever you pass away, your heirs step into your shoes as the note holder, and now they can decide, what kind of income they want from this note. So it's very inheritable. And I had some personal experience with this too. My dad was one of my business partners, and so he passed away a few years ago, and he had, a number of notes. And so I and my next younger brother, out of the five of us, we inherited the notes, and then the rest of my siblings all wanted cash, and so they got cash. And so I've already kind of experienced the inheritable piece of this, and it transitions really well. There's no income taxes due when that's inherited. So you're just passing that wealth along to the next generation, and they can enjoy, what their parents created for them.
So for anybody watching that has a business sale or a real estate sale, I really highly encourage you to get with Kent and speak with him. As he mentioned, he does have a free DST illustration where they'll run through a model and make sure it's a good fit for you, and look at some projections and, hey, what's it going to be like if I use this or I don't use it 10 to 20 years from now. But I really encourage people to look into this, because you're preserving your wealth. You're deferring that capital gains tax bill, and you're putting it into the portfolio for your family and preserving that and putting it to work for you. And especially, like you said, if people want to go buy property, or if they want a joint venture, something like that, being able to leverage that into other things. Thank you very much for joining the show. Glad to have you on today.
It's been a pleasure. Yeah, thanks, Adam. It's good to see you again.